I'm joined by Marcus Grubb. He's Managing Director at the World Gold Council. Marcus is responsible for driving forward the company's research into the strategic role for gold investment portfolios. Big job. Thanks very much for coming in. Why is the price of gold rising?
I think there are four main drivers in the current situation behind the gold price and the strength of the gold market. I think the first one you captured very well in your summary of the current geopolitical, currency and economic situation around the world. You've got very weak economic growth in Western countries, you've got very strong growth in Asia, you've got big deficits and balance sheet issues in Western countries, you have big surpluses accumulating in Asia, and all of that is causing a currency dynamic that is favouring hard currencies like gold. And the FOMC comments on Tuesday triggered a major reaction in the market because we're clearly going to see more quantitative easing in the United States, which will weaken the dollar and strengthen hard currencies like gold. So in general, fiat currencies are falling in value against hard currencies. That's a key part of it.
It's interesting, isn't it? What you're saying is that gold is seen almost as more of a currency than a commodity, with paper currencies becoming less valuable, of course, because we've had central banks pumping money into the economy, and there's now the prospect of further stimulus.
That's right, and I think that links to the second driver of the four, which is central banks. Central banks are now net buyers of gold, and for the past 15 years they were net sellers of about 400 tons into the market. So on top of policymakers seeing gold as a currency and investors beginning to see gold as a currency, central banks are now accumulating gold again as a reserve asset behind their national economic policies and behind their interest rate and currency policies. So you're seeing net buying now from the central bank or official sector in the market, and that's another reason for the strength of the market at the moment.
And what would further QE, quantitative easing, mean for the price of gold?
Well, I think the big debate among investors and policymakers is, will further QE be successful? I think the big risk is if you see further easing and further stimulus to the world economy, or certainly the Western economies, and it doesn't have much of an appreciable effect on economic growth, then these huge amounts of accumulated national debt start to weigh heavily on government bond markets and, of course, on currencies. And I think you'll see gold remain very, very bid in that scenario. Equally, if the policymakers get it right and you see eventually the world does emerge from this difficult balance sheet situation and difficult recessionary situation, there is a risk of inflation because you've had so much quantitative easing, so much money supply growth. There's a lot of liquidity in the world economy, and sooner or later it may create price pressure.
It's fascinating. So how difficult a balancing act are central banks facing at the moment? Not enough stimulus could result in deflation, because there is, of course, a lack of inflation in much of Europe and the US, but then too much money pumped into the economy could result in more inflation, more inflation that they would like. So
yes. It's a huge task, and I think if you look at policymakers in most countries around the world, certainly during the 90s, had a very easy ride. They stuck to monetary targets very easily. Inflation targets remained roughly around the bands that were put forward by central banks, and also trend economic growth in terms of government targets remained roughly stable in a very benign scenario. If you look at it now, following the credit crunch and recession, and you look forward from here, policymakers are going to face a much more difficult task. You're already seeing inflation above trend in the United Kingdom.
Well, that's what I was going to ask you. The Bank of England, like the Fed, has said that they may also go to further stimulus, but of course inflation is right now above the government's target.
Exactly.
Would that be the right thing to do?
Well, I think it means, again, you have a very difficult social utility function and economic and inflation function to optimize as a policymaker. As you said, if you put too much stimulus into the economy, you could trigger an inflation. However, what policymakers are really concerned about now is deflation, because that's even more damaging. Effectively, it means the economic system ceases to function properly, and you get falling GDP and falling prices in absolute terms, which is bad for most asset classes and obviously bad for stability, for economic growth, for employment. And in that scenario, I think hoarding assets and stores of value like gold would also rise after the initial shock. So you can see why both central banks and investors are looking at gold at the moment, given that that is the current macroeconomic scenario we face.
Marcus Grubb, thank you so much for your time. I appreciate getting your thoughts on this.